What if I told you that the rules of the silver market quietly changed overnight, and most investors still have no idea it happened? While everyone was watching stock markets, inflation numbers, and interest rates, something unusual was happening behind the scenes inside the world's largest precious metals exchange. The people who control the trading infrastructure for silver suddenly adjusted the rules of the game, and when exchanges change the rules, markets rarely stay calm for long. Within hours, prices swung violently, billions of dollars in positions were wiped out, and traders across the globe started asking the same question: why now? Because historically, when exchanges step in and change the mechanics of trading, it usually means one thing: the system is under stress. So in this video, we're going to break down what actually changed in the silver market, why exchanges made this move, and what it could mean for the future price of silver. And by the end, you might realize that this so-called rule change could be one of the most important signals investors have seen in years. Let's start with what actually happened. The world's largest metals derivatives exchange quietly increased the margin requirements for silver futures contracts. In simple terms, traders suddenly had to put up significantly more cash just to hold their positions in the market. For large silver contracts traded on major exchanges, the required collateral jumped from roughly 15% of the contract value to around 18%. Now, if that sounds technical, here's what it means in plain English. Imagine you're betting on silver going up. Normally, you might only need a small percentage of the contract ounce value to control a much larger amount of silver. That's called leverage. But when exchanges raise margin requirements, suddenly that leverage disappears. Traders must either deposit more money or close their positions immediately. And when thousands of traders face that choice at the same time, markets can move violently. Now, here's where things get interesting. Exchanges claim these changes are simply risk management. When markets become extremely volatile, raising margins forces traders to reduce risk and prevents the system from becoming unstable. And in fairness, that explanation is partially true. Silver prices have experienced dramatic swings recently, with massive rallies followed by sharp corrections in just a matter of days. But historically, margin hikes often have another effect. They trigger forced liquidations. When traders suddenly need more cash to maintain their positions, many simply sell their contracts instead. That wave of selling can push prices down quickly, even if the underlying demand for silver hasn't changed at all. In other words, sometimes the rule change itself becomes the reason the market crashes. And that's exactly what we saw. In previous margin hikes, silver prices have dropped sharply within hours, as leveraged traders rush to exit their positions. In some cases, millions of ounces worth of futures contracts were dumped onto the market almost instantly. To outside investors, it can look like demand suddenly disappeared, but in reality, the drop is often caused by mechanics, not fundamentals. And that distinction matters, because while paper traders may be forced to sell, physical silver buyers often continue accumulating the metal in the background. This creates an unusual situation where prices can fall even while real demand stays strong. To understand why this matters, we need to talk about something most investors never hear about: the difference between paper silver and physical silver. Most silver trading today doesn't involve actual bars or coins changing hands. Instead, it happens through futures contracts, essentially financial bets on the price of silver. These paper contracts represent enormous amounts of silver compared to what actually exists in exchange vaults. Some analysts estimate that the paper silver market is dozens of times larger than the physical supply. And when margin rules change, it's the paper market that reacts first. Because leveraged traders operate on borrowed capital, if margin requirements rise suddenly, their strategy stops working overnight. But here's the question many analysts are asking: why now? Silver has been experiencing something unusual over the past few years. Demand for the metal has been rising across multiple sectors at the same time. Industrial demand is exploding due to solar panels, electronics, and data center infrastructure. Meanwhile, investors have been pouring money into precious metals as protection against inflation and currency instability. At the same time, mining supply has struggled to keep up. That imbalance between supply and demand has pushed silver prices dramatically higher over the past several years. And when prices move too quickly, exchanges often step in to slow things down. This isn't the first time something like this has happened. In fact, silver has a long history of exchanges changing the rules during extreme market moves. Back in 1980, during the famous Silver Thursday collapse, exchanges dramatically increased margin requirements to control speculation in the market. The result was catastrophic for traders who were heavily leveraged. Prices collapsed almost overnight. But here's the twist most people forget. After the crash, silver eventually began another long-term rise as the underlying demand continued to grow. In other words, rule changes can cause short-term chaos, but they don't always stop long-term trends. So what does this latest rule change actually signal? Many analysts believe it's a warning sign that the silver market is becoming increasingly unstable. When exchanges repeatedly adjust margin requirements, it often means volatility is rising faster than expected. And volatility usually appears when two forces collide: massive demand and limited supply. That's exactly the situation silver appears to be entering right now. If the current trend continues, the silver market could enter a period of extreme price swings. Margin hikes could trigger temporary crashes as traders unwind leveraged bets. But at the same time, strong physical demand could keep pushing prices higher over the long term. Some analysts even believe silver could eventually challenge the psychological $100 level if supply shortages intensify. But whether that happens next year or 5 years from now remains one of the biggest debates in the commodities world. So when you hear headlines saying silver exchanges changed the rules, it's not necessarily a conspiracy, but it is a signal. A signal that the market is becoming more volatile, more sensitive, and possibly more unstable than most investors realize. Because when exchanges start adjusting the mechanics of trading, it usually means the system is trying to adapt to something bigger happening underneath the surface. And in the case of silver, that underlying force may simply be this: demand for the metal is rising faster than the market was designed to handle. Which raises one final question. Are these rule changes protecting the market, or quietly preparing it for something much bigger?